All right. Good morning, everybody. Almost there, getting closer to the end of the week. Markets are still a little shaky, but they had a nice recovery yesterday, doing what they do, right? We had a move down, so we had a reflexive move back up in the other direction without setting a higher high or even getting an equal high. It's a way to stair step lower without freaking everybody out. Did a really good job of it, I think. I think it was just nice and systematic. So looking at what we've got going on this morning, a lot of news focused on the hurricane. That thing is a monster. What a beast. So that's a sneaky one in the background. Nobody's really talking about what happens if it doesn't behave. At least I haven't heard any conversations on that. Markets don't like surprises. So the one thing that I would say that could be a surprise that I haven't heard anybody really talk about would be what happens if that hurricane gets out of control and actually comes in. And that would just be bad everywhere. Other than that, we're going to get some economic data today, some job numbers. The minutes yesterday really didn't do much. And looking at the job numbers this morning, unless we get a surprise and these numbers are way off their mark, these shouldn't provide any sort of shenanigans to the market today. The survey, I mean, it's a survey, not really much to expect out of that. It's all eyes on tomorrow. JP Morgan has put out a letter saying they really don't expect Powell to shake the tree, hold the line, really not do anything. Spot Gamma has backed that as well, saying they're not seeing anything within the options flows that suggest that Powell is looking to do anything wild, or at least the options flow suggests that everybody believes Powell isn't going to do anything, right? Because everybody is positioning, and that's what they can see within the options. So it's very likely that we will make it through Friday as just nothing, right? It'll be one of those hurry up and wait days where we don't get any real fuel, and then we go into the close. Now, the thing is, just like earlier this week when I said, I think it was Tuesday, that low volume days with a lack of fuel to drive us in either direction can become dangerous days where we can really break out and run. And we ended up getting that, and it wasn't foresight on my part. I didn't know we were going to break out and run. It was just the warning, because that's what you have to be mindful of. If it's sideways and we don't have any reason to run and things are tightening up, then you have the risk of really big moves. So everybody's all in knots over what Powell's going to do. And if it does end up being nothing, markets might jump on the lack of something and run with it. We really just don't know, right? There's still a lot of metrics to suggest that we're not in a bearish market. This is just profit taking and reducing risk, and that we don't have it, the broader market setting up short yet. My issue with Jackson Hole tomorrow is that Powell does have a backbone, as much as it's easy to forget that. And the central bankers from around the world have been showing up in Jackson Hole in solidarity, giving speeches about how, they have to stay independent and stand on their own 2 feet. And even if you're being bullied in the public and on Twitter, or, you're getting threats of arrest like Cook and Powell, that you just have to do your job anyways. If they provide him enough backbone for another mic drop moment like we had in 2022, I think it could get pretty exciting. The thing is, he has to understand there's going to be consequences from that. And backbone or no backbone, I think he kind of wants to keep his legacy intact, which is slowly eroding behind him, anyways. And he probably wants to keep his job. So, you know, what kind of shenanigans can he really come up with that threads that needle? I don't know. But I don't think JP Morgan is wrong. I think they're just kind of missing the mark. There is a threat here. We just have to be mindful of it. So out of all of this data that we're looking at, the big one today is the jobless claims. I don't think Bostic's going to say anything of note. He never does. Why would he start now? And, you know, maybe we'll get something out of the U.S. leading economic indicators, maybe, because the numbers are just a little off. But unless the job numbers surprise in some way, kind of give us something we weren't looking for, or they're way off mark, this should be another day where we're waiting on Jackson Hole. We got the 30-year today. That's a biggie. I know these kind of go under the radar, you know, and I've had a lot of traders ask over the years, why do you even bother to look at these? Most of the time, nothing happens. Yeah, I mean, I get it. Most of the time, nothing happens, but that's like asking, why do you pay attention to the weather? Most of the time, nothing happens. Yeah, that's true. Most of the time, nothing happens, but you kind of do want to know if a hurricane's about to run you over. That's a good analogy, I think. These auctions, most of the time, they're nothing. Nothing happens. They kick off without a hitch, and that's exactly what we would want. And you know, Bob's your uncle, and we do what we do. Kind of like going to the races. You go to the races so you watch people run the race, but you know, you really just want to see a car wreck. Most of the time, we don't get the wreck. Watch the clock today at 1 o'clock. That 30-year is a beast. Yeah, no surprises in that so far today. $55,000 in the overnight volume. It's well within expectations. It's really nothing to see there. The range on the overnight also fine. Really nothing to see there. I was talking about stair stepping when we were on the website and not on the charts, but it's the logic of how we get down in the markets, right? If you make really big moves really fast, you kind of tend to freak everybody out, and you reach your goals too swiftly. If you need time to make it to OPEX or some other thing like earnings or whatever, you need time. Got to slow grind without freaking everybody out. So moves like yesterday are really common when you're working your way down in the market, right? They talk about taking the stairs up and the elevator down. Well, that would be the elevator approach there. The other way is stair stepping down, where we get that move down, but we rally back up, being sure to get the lower close. The lower close is important because it's how you get your red bar. Each day's close lower than the previous day's close, but we didn't close, you know, like all the way down here, and that's a really big piece of it. It's the same thing going to the upside. If you close at the absolute high every day, you'll get there really fast, and you start to get overextended. You leave your moving averages behind. You have threats of mean reversion and all that good stuff. So this is just the normal behavior. This is what we're supposed to do. But it's important to note how we closed. And there's a couple of things that throw this off. First, with OCR, we do have the lower highs, perfect in step lower highs. And we had lower lows. Today doesn't count yet on the high or the low because this day is not done. So lower high and lower lows. You only need 2 for a full set. So once we had a full set, we were in trend to the downside. The trend is still intact if we're using OCR style analysis, right? This is different than your normal technical analysis. That thing will snap in place. So far, the lower highs, the lower lows, everything's been fine. But yesterday's bar and the way that it closed has some pieces of the puzzle that are becoming important. One, how did price close? Was it above the midpoint or not? And as we can see, because I just snapped some quadrant lines on it, here is the mid 6,400, and we closed above that. So that's step one, closing above the middle point of the bar is less bearish than if we had closed underneath the 50% bar, right? Hopefully that makes sense. Closing down here is more bearish than closing up here. That's only one piece. The next day, which is today, where we're at right now, we want to close above that mid again. And I mean, you know, we're kind of dancing with it. We're crossing back and through it literally right now. So the day's not done. It's half done, but it's not done. We need to close above this half again, which will help reaffirm where we're at. This green line here is the 20 period daily moving average. And this blue one is the 10. The white one's the 3. We got a 310 cross. That's a surge signal to the downside. And we've broke the 20 and we're headed below it. We're also below the key level of 6,400. So if we were going to turn, we have everything we need to jump over, all coalesced inside of yesterday's price action. I like that big word early in the morning. We got the 3, 10, 20, the half back, the big round number, all within yesterday's candle. All we got to do is break that and get a candle close outside of this box to the upside, push back above 6,450, and we're off to the races again. It is as easy as that, or as simple as that. But if we break and close below 6,400 today, or worse, if we get below yesterday's low today, then 6,350 and then the 50 period moving average, which basically 6,300. Nothing to it, right? We are below VWAP this morning. If we manage to get back above it, then we will look for reciprocation. It's a big fancy word that just says whatever we got on one side, we would want to see on the other side. So we could just take that measurement and we can see we tested that VWAP and failed there. If we had actually managed to get through, then the target would have been something like 64.22, because that would have been reciprocation from this earlier move, right? And of course, that lines us up back here. And so that makes perfect sense. That's the area that was defended yesterday. It's just the way things work, right? They line up just as they're supposed to. The call wall and put wall didn't get moved. You can see that we're still in positive gamma today, so we're above it. And if we happen to get down below it, if above it or below it within a certain range, and there's no exact science for how far is too far, but if we're within a range above it or below it, all those discussions about how dealers will respond to negative gamma conditions, they don't apply, right? That's more of the big picture stuff. When you are consistently below 0 gamma and you're continuing to drive farther away from it every day, and we're just in this really negative gamma regime. Cutting below it on an intraday basis doesn't fit the bill, right? When we're above 0 gamma and we're having rally days, we expect them to sell into strength and buy into weakness, because that's what holds us back, right? It's what stops us from just having big blowout ripping days to the upside day after day after day. And when we're in a bear market and we're consistently below zero gamma and we fall, they will sell into that falling and exacerbate the situation and will fall farther, which is why when we're in bear markets, we get some of the biggest moves that we've ever seen, up and down. They will buy into buying and they will sell into selling. That's the regime that we have in negative gamma. But it's when we are consistently in positive or consistently in negative, not this wishy-washy cutting back and forth through the line day after day. In these conditions, they're not going to respond that way. And I bring it up because I see it mentioned in chat as if, they're just going to immediately respond when we cut below there and begin, selling into selling. And no, that's not how they do it. Plus, they're lazy, right? I know it's called smart money, but first of all, they're not that smart. And two, they're lazy. There's just no better word for it. So, they're waiting to be told what to do because they're not smart and they're lazy. They're not proactive. They're not going to, initiate an action unless they're told to, because like most lazy people, they're just going to sit around and wait for someone to tell them to do it. So no, it don't work that way. Rant over. We blew right through those ADR lines yesterday. It's worth taking a peek at those. Think or swim. I believe I have one that shows the historic, right? That goes back and shows previous days. But the one on TradingView, I believe, does a better job. Right. So to me, this is just really noisy. I don't like it on all the time. But one of the things that I realized after using the ADRs for a few years is that if you don't turn it on, then it's hard to remember why it's so valuable, right? Because you can see the replays when you turn it on of all the times that it was just so valuable. So is it perfect? No, but it's not supposed to be, right? It's a line in the sand giving you an idea of what price is supposed to do if it's behaving normally on a day-to-day basis. That's the key to the whole thing, is what is the average move of this particular market? Because every market is different. Every daily move is different. Yesterday, we cut through that full ADR, but we still got back above it. And on the run back up, I thought it was worth noting this. I love this 3-bar pattern. It's one of my favorites. Rally base drop. But it was right off the bottom side of that thing. So they work in both directions as targets, levels of interest. The average daily range is like channel bands. Someday a platform is going to develop a circle that just follows price. That band is what we're looking for how far could the market move today. And that's what we have today, right? Between those two red lines. That's how far we should move if we behave like we have been behaving over the last month, because this is a 21-day expected move. So if we do, just same old average move, it's one of the things you want to look at every day is there any reason to believe that today is going to behave differently than normal? And funny enough, it's kind of easy to spot when we are not behaving normally. Lack of volume, too much volume, big moves, a lack of movement, headlines. So far today, we don't have any of that. We don't have any standout volume. It's not too light. The headlines are supposed to come in, say, between 9:45, 10 o'clock, unless you want to count those job numbers, 8:30. So we got nothing. They're not hedging into it. There's no market maker move up there. We are closer to the lower ADR than the upper ADR, and the lower ADR is inside of yesterday's trading range. We don't need an inside day breakout to get to that lower level. So base case scenarios, we go ahead and we hit that lower level. 63.82 used to be a cog line, or at least the 82s were a cog line back in the day. It may still be. I just don't validate them because it takes weeks and weeks of work to validate a level. It's just not worth it. But 82 is an area of interest. That's really close to it. Then there's the half back of yesterday, also worth keeping an eye on. 63.96 is basically what we're dancing on here. We tested it once and now we're testing it again. Very likely once we break that, then we'll go ahead and get that ADR done. If we manage to get through the ADR, then we'll test yesterday's low and then we'll have the full ADR. Today's floor pivot is significantly lower than yesterday's pivot. That's bearish. Price opened above it, that's bullish. Those two kind of cancel each other out. The width of the channel today is not really all that much different than yesterday's, and it's a wider channel than it could be. Wide channels imply that if we break out, it doesn't stick. We don't have an MDP because we've already hit it, but we had one yesterday. So that's an example of a MDP, missed daily pivot. We never did go up and hit that pivot. But we did talk about S&R lines yesterday. We were talking about how an S1 can lead to an R1 or an R2. Once we failed to make it back to the pivot and we broke the S1, S2 was a fair bet. Now, we never made it to S3. There are things like halves. So you can have half, 1, 1.5, 2, 2.5, 3. I don't really mess around with the halves that much. It's just this so much noise on the chart. I'd rather have less than more. But after yesterday's big expansion, you can see that today's S&R levels are wider. Hopefully you can also see that even though R3 today and yesterday are about the same, S3 is significantly lower because this indicator is projecting downside movement. Now, this indicator doesn't make price go anywhere, right? It's not making us go up or down, but it is telling you it's math bias. The bias is to the downside because that's what the math says, to the downside. One thing that I like to do every day is to check the distance between R1 and S1. How far away one is from the other when it comes to the floor pivot. So it's kind of hard to see in the stream, but R1 is right here and S1 is right there. If you measure those two, a lot of times they'll be equidistant or so close that it doesn't even matter. But if you have one side that's farther away than the other, then that's the projection of the market calculation. That's the bias that this indicator is giving today. It's built in. If you want one that's a little easier to read, then you could use Person's pivots. His does it for you and removes the lines that it doesn't need. Just kind of smart, really, if you think about it. So you can see that for today, for an example, there's one red line, one green line, and the green one is much farther away. Same as yesterday. Red was closer, green was farther away. Closer, farther away. So it's already built in, and in my opinion, it's a lot easier to read. right? But yeah, I guess there really isn't any but to it. That one's called Person's Pivots. We really don't have anything here this morning. At least nothing that's not a surprise. 6411, we're building out some structure there. If it breaks, we've got 6350. Other than that, it's confirming what we've already known, but really not offering us any insight yet. Even the value area hasn't shifted and the point of control hasn't moved yet. So we don't really have anything new out here. Ten-day, 30-minute volume profile and TPO, same thing here. Not anything new. We're still looking to remove the candles on the left with new candles on the right to get this to shift. And it's very likely now going to end up at 6411 because even as we're wiping out the footprints we left behind a few weeks ago, we're putting in new ones. And there's nowhere else for this thing to go. We are starting to show up with a classic double distribution, and it's been a while since we've had a classic pattern on the 10, the 10-day, 30-minute. Normally we come out here and it's like this big wadded up piece of bubble gum that doesn't really have any pattern to it at all. It'd be nice to get some pattern and some structure again. All right, 64.26. We took that one out. You know, I'm gonna leave it on there just a little bit. That showed a lot of pizzazz, I guess. That's the best word I've got. I'm gonna keep it. 64.09. We're done with that. That was just a regular point of control. And 63.71, also just a regular point of control. We have a VPOC from yesterday, just barely, but barely counts. So we have not hit yesterday's floor pivot. Yesterday's point of control, not floor pivot. So since we haven't hit it, that is a VPOC rather than just a regular POC, point of control. Now I'm not going to dial this thing in to the tick. I get it down to the point value. It's close enough. So point value seems to be 64.20 or 64.19. You can take your pick. Or if you want to, put it down to the absolute tick, kudos for you. You do you. 64.20 is close enough for me. We haven't hit that yet. That makes it a VPOC line. And above that, we've got 64.26. It's a line in the sand from Tuesday, and I'm keeping it right now. It's just a level of interest for me at this point. If you didn't have that, then the common thing to do would just be to use yesterday's high and yesterday's RTH open. It's a really good one to use anyways. So even if you didn't have that level, you would still have the same zone that I am talking about just from yesterday's RTH high and RTH open. This morning, we have nothing down here, right? The point of control matches. It's just a classic distribution, a little ugly, but it's fine. And down at these lows, they're not coming in with big, massive structure, right? We don't see big footprints down here. Giants aren't walking yet. On the daily, we're still below the 10, but we're within a 0.5%, barely, but hand grenades and horseshoes. Not extreme. We're not oversold. It doesn't owe us more. It doesn't owe us a mean reversion. We're sitting pretty good there. On the weekly, we're still above the 10-week, more than 1.5%. So we're good. Just hanging out. This is not a bad place to be. It's healthy. The concern is how fast we can get below the 10-week, and I mean it can happen really fast, right? This thing can go from a +3 to a -2 in a single day, just violent transition. But now we're already close enough to it that if we were to transfer from above to below in a single shot, it won't be so bad, right? Like back here, we were at +2, and by the end of the day, the next day, we were almost at a -2, almost. Right? That was a pretty violent move. We did reach the edge of the weekly expected move yesterday. We overshot it, came back in. So far on the week, we are still within the weekly expected move range. 63.82. 82 is a cog line. Back in the day was a cog line. It's a level to keep your eye on. It's very likely if we continue to move to the downside today, that level is going to come back into focus. 82. If we're looking for a capital rotation over the last 5 days, tech down 3%, healthcare up almost 3%. There's your rotation. Staples plus 1.5 versus consumer discretionary -1, right? We're just rounding, make it easy. Industrials flat with utilities flat and building materials flat. And really financials, I mean, 0.25%, negligible, basically flat. So tech wash, and we saw that tech wash, right? If you watch the weighted versus unweighted, which monitors the outperformance of the Mag 7 against the broader market, we could see that sharp reversal in that tool earlier this week. The Mag 7 is no longer outperforming the broader market. And the rotation out of the Mag 7 has led money flows into staples and healthcare. But they're not really dumping financials and consumer discretionary. It's mostly just tech. Remember, they'd rather move money from one spot to another than go to cash. They'll pay a penalty to go to cash. Looking at what's down this morning, we got Bitcoin Mag 7 up volume is down. I know that's a head twister. Bonds, gold, but not enough, or at least precious metals, miners, but not enough, right? They need to move a little further. China is down, but not enough. So, I mean, the headline ones, Bitcoin being down, that is our appetite for risk. If they're not willing to take risk, then it's going to be hard to find anything else that has upside momentum. And looking at what's up this morning, well, nothing. The Mag 7 down volume is up. I like that for a brain twist. And uranium and VIX. Yeah, I mean, Bitcoin's down, but it's on support. I think OKLO had news today that ties in with uranium, right? It's one of those SMR style companies that would fit with uranium being up. And crude is up. But really, I mean, those two are all we have. And to the downside, well, everything else. So keep your eyes on market breadth this morning. If we're going to break down like we did yesterday or break out and try to work our way back, then we have to continue to ask what's going to be the fuel for the driver. Options, commodities, treasuries, it's going to be something, right? Price won't move on its own. Something is going to be driving it in the background. Dollar, yield, oil, something. 0-day options flow. So if we get a surge in the Mag 7, for an example, that could drive us up or down, whatever direction they go. Or we get some 0-day options flows that come in, that can kick us out the gate. But we have to get out of the box, as it is every day. GTFO, get out of the box. The box today starts like it does every day with Globex, which happens to be expanding to the downside as we're looking at it, but we'll start with what we have. The RTH of yesterday, which is bigger than its Globex. If it wasn't, then we would start with that. Well, I guess we got more. RTH first, and then all of yesterday second. So if you want to break out, you got to get above that or get below that. First, get out of our own box. A defining characteristic, by the way, guys, something I used to get hung up on all the time is the classification of trend on an intraday basis. A lot of traders that are day trading get hung up on the idea that they want to trade trend, and then they can't recognize, quote, trend. It's got so many varied definitions. So one metric that I came up with a long time ago to define if today had the opportunity to be a trend day is whether or not we are inside our own price action, either from the Globex or from yesterday. With that in mind, today cannot be a trend day unless or until we get outside of this box. As long as we're inside this box, we cannot have a trend day. That was the rule that I developed a long time ago. Does it mean that we can't see trending price action? No, of course. I mean, depending on what time frame I go to, any day can have trending price action, right? Even that sideways day that we had this week, way back here on Monday, even this trash, if I was to go down to a 30-second or a 1-minute chart, even this had trending price action within it. Say from this low and that high, that run right there, that would have had some really nice trending price action in it on a smaller time frame. So we can always find, quote, trending price, but on the day, if you're looking to classify a trend day, that was one of the metrics I used. It has some issues, right? No classification is perfect, but it simplified a lot of things just by having something clearly defined. I still use that dynamic even today. So if I'm looking for a trend day, we have to get out of that range to even begin the trend. The likelihood of that happening is very low, that we get out of the range defined by yesterday and we get even more on top of that and continue to go. It would take some serious headlines or some, really big news. And we're not expected to have that. So unless we get it, if we reach the edges, mean reversion is the base case scenario that we flip it and come back in again. Bear trap on the downside, bull trap on the upside, and then we just come right back in and we maintain the range into Jackson Hole tomorrow. Unless we get some wild news that we can't see yet. All right. 15 minutes until job numbers, guys. Be careful, be safe. I'll see y'all tomorrow.